On February 1st, we started a $10,000 account, which has since returned nearly 70% in less than 6 months, obliterating the market and making our moms really proud of us. So in this video, we're dissecting our top 3 favorite trading strategies that we use to achieve these returns, and hopefully you guys can get some ideas that you can also incorporate into your own trading strategy. Number 1, reversal strategies. One of our favorite reversal strategies is based on supply and demand. We identify where option dealers have the most exposure by assessing gamma exposure, and then we create what are called dealer cluster zones. These zones are where option dealers are most likely to be active, and in our experience, these are the levels where reversals often happen. Our algorithm automatically detects these zones in real time, but you can also estimate where these zones are by analyzing the option chain and finding strikes where gamma and open interest are very large. The key to spotting a great reversal setup is when a stock or ETF is bouncing off of one of these dealer cluster zones, while simultaneously a large gamma exposure concentration is growing in the opposite direction. This is often a signal that the reversal does in fact have momentum, and that there's also either supply or demand at these levels. In this case, we're looking at Tesla, and this particular reversal is showing that there's a lot of supply at the 235 strike, including from option dealers, forcing price lower down into the 220 strike, which we're actually seeing happen today. Let's look at another example. This one is actually on Netflix, which we had posted in our trading community Discord. And you can see here, we're actually highlighting the move off of the lower dealer cluster down here, moving all the way up into the higher dealer cluster, just missed it by a slight hair, had a reversal all the way back down again to the lower dealer cluster. And so our idea was that there is a potential reversal about to take place from this lower dealer cluster. Why is that? Because we saw a large gamma exposure concentration right here at the 600 strike. That large gamma exposure concentration was staring us right in the face, and so we were suggesting there's a high probability of a bounce back up into that level. Just a quick note here, at the time we posted this, Netflix was trading at 573, so this is 27 points higher from where we're currently trading. And just a few short days later, Netflix was actually back tagging that 600 strike just as gamma exposure had predicted. We had posted right after the 600 tag, highlighting that this was probably a good opportunity to unload positions and log in some nice profits. Our number 2 favorite strategy for small accounts is 2 sigma moves. When a stock price moves beyond the 2 sigma level, it may indicate a significant breakout is happening, leading to a continuation of the trend. Let me show you what I mean. Here we're looking at Bollinger Bands. Bollinger Bands are a great way to measure a 2 standard deviation move or a 2 sigma move. Here we're looking at the IWM. IWM had been selling off pretty dramatically going into November of 2023, and then we see a bounce happen, pull back, and then ramp right into this top blue line. The blue lines of the Bollinger Bands here are representative of a 2 sigma move. And so if we just zoom in here, this point in the middle of November, piercing the top Bollinger Band was a big signal that a breakout and continuation of trend was likely. And just look at how strong the move is. IWM trading all the way from the 170 level down here all the way up to 205 before it finally topped out. And that's why we love these 2 sigma moves so much. This particular approach is contrary to a lot of popular strategies which try to incorporate a mean reversion trade based on a 2 sigma move. But we found in our experience that a quick thrust into a 2 sigma level often signals a confirmation of a trend move. The key to trading 2 sigma breakouts is to look for consolidation or slight pullbacks for your entry point once a breakout is confirmed. So going back to our example here on IWM, you can see the initial pierce of the 2 sigma level was followed by a few days of reversal / consolidation, which offered an optimal entry point just above the 175 level. Let's look at another example just a little bit further out in time. This time we are in February of 2024, and we see another 2 sigma move coming off the bottom here all the way up, piercing within just a few short days, piercing this 2 signal level again on IWM. The very next day, we had a very sharp pullback right into the orange line. The orange line is actually the mean or the 20-day simple moving average. And so depending on how aggressive or conservative you are, you may want to wait for a move back down into that mean before going long. However, if you do that, you may miss the opportunity like we saw at the beginning of November here. The price never came back to the mean. So you kind of have to decide. We like to leg into positions. So for example, if you took this opportunity to leg in to this move here back in November, you had at least some position in the move before it started rocketing higher. In this example over here in February, the move was so quick that you basically, the next trading day, you were entering right around the mean. And sometimes these plays take a few days to play out. You can see there was some volatility here, piercing the 2 sigma level again before bouncing back to the mean again before rocketing higher. And so Bollinger Bands and also other indicators like Keltner channels, these are great ways to identify these 2 sigma moves. And what you want to look for is both bands trending higher along with the mean. In this example, by the time we breached the 2 sigma level, had our pullback, look at what the outer bands and the mean are doing. They're all trending higher at that point. And so that's what we want to look for. We want to look for a significant shift, an uptrend in the 2 sigma levels and the mean to signal that the trend continuation is likely to take place. The reason these trades are so effective is they serve as a filter, helping us identify stocks that have moved more than 95% of readings, which in a trending market basically means that we're finding the stocks that are making the largest relative moves. It's kind of like finding the market's list of top gainers or losers, but incorporating a momentum factor into the analysis. Our third favorite strategy for small accounts is precision strike trading. Precision strikes are strategies that target specific levels of confluence in trending markets. For example, here on GLD, we see that a previous high from a few weeks ago has a confluence at the 230 strike of a large gamma exposure concentration. Furthermore, if we just take a big picture zoom out and look at the top of this trend line, we can see that the 230 strike is also a level which hits the top of this trend line yet again. This is oftentimes the types of confluence that we're looking at. Technical indicators, earnings data, gamma exposure data, trend data, all working in unison to point to precise target levels. So these are all strategies we've used which have boosted our small account portfolio by 70% in less than 6 months. Reversal strategies, 2 sigma moves, and precision strikes. So we discuss our approach to these strategies every day in our trading community Discord. It's free to access. There's a link in the description below. Come on in and say hi. Also, if you're interested in accessing our gamma exposure dashboard to get you the data you need to develop your trading strategies, I'll put a link in the description below. Also, just a side note, our members get free access to our Geek University course. It's a 5-hour course which teaches portfolio strategy, risk management, as well as going in depth into our trading strategies. So be sure to check that out as well. Anyways, that's it for this video. Thanks so much for watching, and we'll see you guys in the next video.